Just get, perhaps another mind to weigh in on that. Shawn Hickman, research lead at Market Matters, joins us here in studio. Shawn, welcome. Do you have any clue why we've got so much positivity coming through early in this session?
I could throw two ideas into the mix, but it is stronger than I thought. I would stress that. I think the market got cautious into Easter. You know, we had obviously the unemployment numbers coming out over Easter when the ASX was closed. So I don't think many traders would have gone home long, just in case. You know, that people are a bit scared, a bit nervous up here with the market fairly firm. And I think secondly, of course, the Newmont having another tilt at Newcrest, you know, shows people that our miners in particular are cheap in lots of people's minds. I think the whole gold sector probably is still quite cheap. And so it's positive. Now,
Newmont's offer for Newcrest is best and final in the absence of a competing bid. Do you get the sense this has gone on so long that there is unlikely now to be a competing bid?
I don't think there will be. I mean, Barrett made a point of saying before that they weren't probably looking at it. I think that's the right way of putting it. They weren't looking at it, you know, and the market is trading at $30 this morning. I just had a look at the screen. 33 is basically the bid, just below 33. So the market's saying, we don't think this is going to happen. We think the board are going to say, again, we've seen this so many times this last 12 months, that it's too cheap, it's too opportunistic, et cetera, et cetera. So best and final at 33, will they get it over the line? My gut feel is maybe not now. I hope it does, because we're long Newcrest, we're enjoying the move, but the market's trading on that negative side of things. It doesn't seem to believe it's going to happen.
Okay, interesting. Thank you for those questions without notice. Now, let's get to some of your charts, because we're still very concerned about U.S. recession. U.S. bond yields, what are they telling us in your view?
Well, I've put these charts in today because, of course, the market's been closed over Easter, so I couldn't be very stock specific like I prefer to be. But we think the bond yields might be getting a bit ahead of themselves. They are telling us there's a recession on the horizon. We've got the spread between 2s and 10s, the spread between the shorter dated bills, all saying multi-decade read-throughs of we are going to get a recession. So the spreads are getting incredibly wide. They're saying recession. How deep may be the biggest question. And we think bond yields are already pricing this in. So I'm not sure what chart you've got up there at the moment. But, you know, so, you know, you've got a situation. Let's keep it local now. Let's just say the RBA, as we all know, have pushed rates up to 3.6%. People think they may go one more time. People think they won't, whatever. We don't think they will. So that's 3.6%. And yet you got the Australian 3-year bond yield trading under 3%. So people are already starting to talk about rate cuts this year or into next year, and we think they've probably gone too far. So we didn't think that bonds, the RBA would go through 4%. We were in the minority then. We actually don't think we were going to be getting the rate cuts that everyone's looking for, and that's a very interesting read through to markets. So if we're not going to get rate cuts as fast as people think, then you might see more money flowing into value stocks as opposed to the growth stocks after we've seen growth outperform for the last 4 to 6 months.
Okay.
So I talked a lot then. I hope that all makes sense.
Yeah, it does. So that's interesting. So, you know, when we get this inflation read next week, that's going to be hugely instrumental to help determining where you think that the RBA is going to go.
Exactly. Yeah. Exactly. I mean, the thing is, the RBA doesn't quite know how big a lag factor we're going to get by the mortgage cliff, even though Mr. Lowe has said, or Dr. Lowe has said, it's not a mortgage cliff. It's a lot of people are scared. You know, we saw last week in the US, I think we got a 400% increase in the number of people losing their jobs. So the layoffs are getting bigger. We've got things are slowing down. We know things are slowing down, and it's very, very hard to know how far they're going to slow down. So, you know, the RBA, the Fed, they've pushed rates really hard. They've been very aggressive. We all know that, and they're fighting inflation. I think anyone that thinks they're going to suddenly pivot around and start cutting rates is mad. You know, I just can't see it happening. They've got a situation where they've got inflation, I won't say under control, I think that would be getting a bit ahead of ourselves, but they're slowing it down. And I think they would like to sit back now for a few months and at least see what happens. Our personal view, or my view, or Market Matters view, is that the RBA will leave rates at 3.6% all year.
Okay. Now, we have seen tech outperforming, as we have seen, you know, some pressure coming off US yields. Is that likely to continue?
I think that's running out of steam. I think that trade is quite mature. So the interest rate sensitive names have had a really, really good rally. So it depends on your time frames. This is something we've talked about before on the show. It depends on your time frames. I think over the next, you know, couple of months we might see that revert slightly. But we're still, for example, very, very bullish gold over the coming years. and that by definition is an interest rate sensitive play. So it depends on your time frame. If you're a trader, short-term trader, which we're not, we're long-term investors, I would say that the interest rate sensitive names are probably going to just slow down a bit. They've had a really, really good run. But conversely, in the bigger picture, we really like what's going to come through for precious metals, etc.
Okay, so gold above 2,000 was achieved. Gold above 2,100, can it be achieved? When?
Oh, absolutely. I mean, I said above 2,000 a few months ago.
Yeah.
It's there. Newmont obviously think it's good value here, although they wouldn't have raised their bid for Newcrest. I think when it goes above 2,100, I made a comment in the Market Matters report this morning that the next $50 in gold, it's a toin cost. Toin cost, yeah. But what I believe is we will be above 2,100 this year, definitely. And I wouldn't be surprised if we're above 2,200.
Okay.
We're very, very bullish gold.
We'll remember that.
I know.
11th of
I know
April.
you didn't write it down this time.
I didn't write it down. I lost my piece of paper. Anyhow, when we talk about the US dollar, because that's going to be instrumental in all of the aforementioned, do you think the US dollar is likely to be pressured if we do end up seeing a pause coming through from the Fed? And I just had a conversation with Sean Callow from Westpac about the interest rate differential that has been, keeping the Aussie subdued. But still, this US dollar strength has continued to be a story in 2023.
No, absolutely. I think we're going to go through a bit of a boring time in that phrase. I mean, we've seen bond yields have moved a long, long way back of late. They've corrected back of late after a huge run, as we know. And the same things happen in the US dollar. I can see the US dollar consolidating between that 101, 105 level in terms of on the index level, and having a pause. So I think a lot of what we're seeing in the last 3 to 6 months is now built into things like the US dollar. And I can see a short-term bounce, but overall, I don't think it's going to be as strong as it has been. We're a bit more on the fence with the US dollar short-term.
I was a bit surprised to see a pound sterling chart in your pack this morning. Why are you keeping an eye on that?
I just threw that in there, for want of a better way of putting it. A, because I couldn't put many stocks in today because they're all closed over Easter. But B, you look at it, it's gone up over 20%. So that's what we're saying. The stocks or currencies I should say, like the pound, it's absolutely surged. It's had a huge rally.
I didn't realize that.
Yeah, it's had a huge rally. So if it pulls back below 120, it's nothing. It's hardly a blip on the radar. But that is likely to be because US yields, probably have a bounce back about 4%. So it's all part of that consolidation phase that we think is going to be coming. It makes it quite hard to be excited about something because we think we're going to have a rest.
Okay.
And that is a good example of one of the ones that we think will.
What's not resting? Bitcoin.
I know. Well, Bitcoin is something we haven't invested in. It's not sort of on our menu. But I did put that in there today as our last chart because it's above 29,000. It's at a 10-month high. I'm not sure how many people on your show look at Bitcoin. I'm not sure if you've researched that, but people would like to keep an eye on it. It's a good read through on how much free cash is in the market. And if they're chasing Bitcoin above 29,000, suddenly they're looking at 30,000, 10-month highs, that tells me there's still a lot of free cash slushing around for people to have a punch with, excuse the phrase, even though we had a banking crisis only 3 or 4 weeks ago.